Hi everyone, I'm Jaron Van Alphen, Certified Financial Planner and founder of Centered Financial, and I have a quick Ask Jaron video for you answering the question, what's going on with bonds right now? So to dig into this question, first of all, let's talk about where we're at. Right now, we are in the middle of the longest bond bear market in history. Bonds just have not provided good performance over the last few years. It's been one of the largest drawdowns in bonds that we've seen, and we're still in this situation. So what's causing this? Well, the expectation this year as we came into 2024 was that the Fed would start taking actions on interest rates. Remember, bond prices are directly inverse to the direction of interest rates. So as interest rates go up, bond prices go down and vice versa. So the expectation in 2024 was that we would have some rate cuts, interest rates would start coming down, and bond returns would likewise start coming up. That hasn't happened yet. Right now, yields continue to drift up because we've had a strong economy and inflation has been pretty sticky, making the Fed's job pretty difficult to balance as far as what they're going to do with interest rates. And that's pushed the expectation that any rate cuts that may happen will be later this year, if we receive any at all. Because of that, again, yields have drifted up and we've seen negative returns so far this year in the bond market. So unpacking this a little bit further, I want to show you this chart on the current yield curve. So to understand the yield curve, this is the relationship of interest rates, of yields with time. So a healthy yield curve would have an upwards sloping curve, meaning that we would expect smaller interest rates for the shorter term periods and higher interest rates for longer term periods. An easy way to think about this is I like using CDs as an example. If you were to put money into a 6-month CD, you would normally expect to get a lower interest payment on that 6-month CD than a 60-month, a 5-year CD, because the risk that you're taking by tying your money up for longer. However, that's not the case right now. Right now, you're receiving a higher interest rate for that short-term CD versus what you can get on long-term CDs. Bonds are the same way. Right now, short-term treasury bills are paying a lot higher rate than what we're getting on a 10-year treasury bond. So with that in mind, it poses the question, why should we even use bonds in our portfolio to be a hedge against stock volatility? Why don't we just put money in cash? This slide does a good job of posing that question. Right now, those short-term interest rates are yielding higher than what we can receive on the normal longer-term bond. That's a very unique time. As you can see, less than 10% of history, we've been in this situation. So if we can put money in cash and not take as much risk, and get a higher yield, why would we even consider bonds? Well, it depends on what we're using the money for and how long of a time horizon we have to invest that money. What is our objective? And I'll dig into that a little bit more. Let me show you what I mean. This chart is really helpful to understand how we gauge what we think we're going to get on our future bond returns. So what this chart is showing is the relationship of the 6-year lagged aggregate bond yield versus the 6-year lagged aggregate bond total return. So what that means is just the relationship of the bond yield versus the bond return looking back over 6 years. As you can see by this chart, the relationship is pretty correlated, meaning that these two lines are moving in sync with each other. Right now, this yield curve or this yield line has spiked upward and return hasn't caught up. But if we use this historical relationship as an indicator, which past performance is not an indicator of future results, but this is helpful to gauge our expectations of how this relationship should go. If we use the historical perspective as an indicator of this relationship, we would expect the returns to catch up with the yield. So the yield right now, this is showing a 4.85% yield. What that means is we would expect that over the next 6 years, our average return in the bond index would be about 4.85%. So this is just something that as a portfolio manager, we use as an indicator for what expectation of return we might have in bonds. And the current yields tend to be a good indicator of what we can expect over the time horizon of the duration of the bond. So if we can get a 4.85% return on our bond portfolio, on that piece of our portfolio that's invested in bonds, historically, that's a pretty respectable return for a bond investment. To go one step further, we want to look at the relationship of bonds to cash when we're investing over a longer period of time. Cash, there's nothing wrong with putting your money in cash, and I always recommend that you have a good cash reserve built, and that should be for your short-term security needs. However, if we hold money in cash for too long, then we know that inflation can erode its value. So let's put that into perspective. If we look at 2023, just over 1 year, holding money in cash, if we put your cash under the mattress, don't put it in anything that's giving you any yield, you would have lost a little over 3% over 2023 on the value of your dollar. Just that's where inflation took it. However, if cash was providing a pretty good yield, so you would have actually earned 1.5% above inflation and made some money by putting your money in your savings account, yielding a respectable cash return. If you would have put money in bonds, pretty similar, but you earned actually a little bit more, 2.2% over the year. So not too bad. And again, these are pretty close. So the question is, why should we take any risk at all if we can get a pretty respectable return on cash? And then obviously stock market did great in 2023. So, $1,000 invested in the stock market did very well with a 22% return. The real risk is if we look over a longer period of time. So if we look at $1,000 over the last 30 years, what inflation has done to that, putting it under the mattress, you would have lost more than half your money to inflation. So a negative 52.5% return. Your $1,000 is worth $475 30 years later. If you put it just in the savings account and leave it there, you lost about a 6% return over that time period. So your $1,000 is now worth $938. If you put it in bonds, you actually made money. You made 55% on your money. So this is the key right here, is when we're looking long term, investing for retirement, investing for college savings over time, anything that we're going to put money for the future, we want to have a good diversified portfolio of stocks and bonds where we're getting some growth and not losing money to inflation. So hopefully that puts it into perspective. There are specific objectives for cash, for bonds in the portfolio to be a hedge against stock market volatility and provide income and stability in your portfolio, and then obviously investing in stocks for long-term growth. Please let me know what other questions you have. I'm happy to record another video and send it your way, and we hope to talk to you soon. And just a quick disclaimer, this video is purely for educational purposes. It's not meant to be financial or investment advice for anyone. Please reach out to us if you have specific questions. We look forward to speaking with you, and please look for more videos to come.